I'm Will Woodall. I'm joined by Mike Rarey from CAP STRAT. Good morning, Mike.
Good morning, Will.
And we're here for the July update, aka the bear market bounce month. Quite a month in the markets. If we throw the board up here, we can take us through the returns. Pretty strong bounce in equity markets and fixed income markets.
Yeah, exactly. A lot of green on the board. That furthest left column is just the month of July. See the S&P 500 for the month almost up 10% on a total return basis. Small caps up over 10%. And also seeing a rally across fixed income markets. So high quality investment grade bonds, Bloomberg US Aggregate Bond Index up over 2, high yield bonds up almost 6. And then also seeing some rallies in the alternative space. So a very strong month. Quite different from the experience year to date. And you see, even though we had this strong rally in July, does not materially change the return environment in the year to date column. Still negative returns across equities and fixed income, with commodities really the only green on the board.
Yeah, and it was a pretty broad bounce across the board. I think, especially in the NASDAQ, we had quite a reigniting of some of those stocks. So let's throw up the next chart and look at the technicals for the month, and just make any comments here relative to value growth,
et
cetera.
Yeah, piggybacking on exactly what you just alluded to, the NASDAQ 100 is shown there in green. You can see a near-term bottom forming on June 16th. That's the same day that the S&P 500 in dark blue formed its near-term bottom. And since that date, NASDAQ 100 has rallied 16%, and the S&P 500 has rallied 13%. So a very strong bear market rally. This is something that rallies of this magnitude are a common characteristic of bear markets. So not surprised to see a rally of this magnitude.
Yeah. So we get the obvious question from clients and from people generally: is the bottom in? Are we safe to invest again? And we've seen people come back into the market, but a lot of what characterized this bear market bounce was a lot of short covering. It was very low volume, and there's really not a lot of conviction behind sort of what we're seeing here. So let's turn to sort of what else happened in July, which were some big things: inflation, rate hikes, a lot of this stuff that will help us sort of frame where we're going here. And help us sort of put into perspective this bear market bounce. So let's start with inflation. Look at the path of inflation after a historically high inflation print in July.
Yep. And what you see here is what we've been forecasting for quite some time. The consensus has been forecasting as well, that the year-over-year headline CPI has peaked, and we should transition from a high and rising inflationary environment to a high and falling inflationary environment. And this, once again, this is something we've been talking about for quite some time, but notably since about mid-June, this has become more and more consensus, the idea that inflation has peaked, particularly headline inflation, because we have started to see clear evidence of those headline things, food and energy prices, starting to roll over and come down. We've seen gasoline prices come down. We've seen food commodity prices come down, and those should start feeding into the headline number over the next few months and putting downward pressure on it. So if you're trying to pin some type of a fundamental reason to this bear market rally we saw, you could definitely fit a narrative that first half of the year was all about the inflation shock and the interest rate shock, and those things were linked. The interest rate shock was because inflation kept beating expectations, and now that inflation should start rolling over and that becomes more consensus, well, perhaps those two things are done. That part of the story is over, and perhaps it's okay to buy equities. We obviously think it's a much broader story than that, but if you're looking for a fundamental reason as to why we had this bear market rally, it probably starts with this chart becoming more of the consensus narrative.
Yeah. So let's talk about the Fed rate hikes this month and what the change in expectations has been, because we're still pricing in another 100 basis points of hikes before the end of the year, which, as we're seeing growth slowing, is not good for. It will help tame inflation, but it's really not good for growth. It's going to continue to push down growth. So look at the change in expectations here and take us through what happened during the month.
Yeah, a chart we've been monitoring very closely. If we focus on the dark blue line, that's what the Fed funds futures market thinks the Fed funds rate is going to be at the end of 2022. And the first thing to notice is it has stopped going up. This has pretty much been going up all year, and it stopped in mid-June, which coincidentally is right when equity markets sort of found a near-term bottom here. So that's the first thing you note. Second thing you note is, although expectations have stopped going up, that doesn't mean that the Fed is going to stop hiking. So you'll still see a gap between that dark blue line and the green line. The green line is what the Fed has actually done thus far. And the consensus is still that at the September meeting, get a half a percent rate hike, and then 0.25 percentage point rate hikes in November and December. And that has become consensus that will roughly wrap up the rate hike cycle. So the Fed funds rate at 3.25 by the end of the year, wrapping up one of the fastest, most aggressive rate hike cycles we've seen since the 80s.
Right. And compare that to where the 10-year is now.
Right. The 10 years below that. So it is, because the growth data has obviously slowed. Inflation data has started. It should start to roll over here. We believe if the Fed hikes up to what the market expects by the end of the year, the whole curve will be inverted, meaning every other maturity on the Treasury yield curve will be below the federal funds rate. And that, once again, does not signal great things in terms of economic growth or profits or the credit cycle or anything like that.
So the obvious question would be, well, why doesn't the Fed see this and just stop hiking rates?
So it has also become consensus that the Fed is willing to sacrifice economic growth in order to, sort of lose the battle in terms of economic growth in order to win the war on inflation. So they feel their reaction function is much more based on inflation than it is economic growth or markets. At the very beginning of the year, we said in our bear case scenario, if the Fed hiked 5 times, 0.25 percentage point hikes, they would probably have to stop because the S&P would be down over 20%. And they would usually react to that. And it is not factoring into their decision making. They need to see inflation on a month over month basis come in negative, or at least below their target, and get a few months of that before they can feel comfortable pivoting. They need to make sure inflation has been defeated before they could even think about stopping hiking rates. And that means things in the economy are going to get ugly. Yield curve's going to get ugly. There's going to be a lot of ugly stuff going on.
Right. And let's talking about ugly stuff. Let's go on to the next 2 charts. I think the path of liquidity, and then a new chart we have, net liquidity, and talk about the impact of liquidity, because really this is a key chart for us in terms of how we see the potential for an actual bottom forming in the stock market.
Yes, exactly. The inflation shock and the interest rate shock, hopefully those things are behind us. But what's now happening is we are in the midst of the liquidity shock. Because the Fed has had to hike rates so aggressively in order to try to tame inflation, because they're just now starting to reduce the size of their balance sheet much faster than they have during previous tightening cycles, and because there's no fiscal stimulus on the horizon, nobody wants to be seen doing anything that would contribute to inflation. What you see is what we're going to go through right now, which is the fastest slowdown in money supply growth we've ever seen. Liquidity will be slowing dramatically. And one common characteristic of market bottoms, especially in sort of the post-tech bubble era, has been a rebound in liquidity. That has been what has helped equity markets find a bottom and recover. And if you look at our forecast, what we're expecting here is a slowdown in liquidity and then a bottoming, but no real recovery to speak of. it's going to be very difficult for the Fed after they get through this big collapse in liquidity to reverse course, because once again, they need to make sure inflation has been defeated. And why would they run the risk, especially if they have to go through putting the economy through a big slowdown? Why would they run the risk of inflation coming back by doing things like cutting rates on the other side of this slowdown, adding to their balance sheet, anything that would bring liquidity back up?
Yeah. So I think early last week, we sort of heard this narrative forming that the Fed is pivoting, like the Fed pivot has started. Explain, first of all, why that's ridiculous, but like, why did market participants think the Fed is pivoting?
It's really difficult to say. There are clearly no signs of a pivot. I guess if you were trying to point to anything, you would look out at the Fed futures market and see that in 2023, the market expects about 0.5% of rate cuts. That, in our view, is not a pivot. That's sort of a policy adjustment. Historically, when we've seen policy pivots that are significant enough to create market bottoms and sustained rallies, they include cutting the Fed funds rate down to something close to zero and actually increasing the size of the balance sheet. So once again, until inflation is dead, it's not even fathomable that the Fed could pivot in the way we're used to. It would be such an incredible loss of credibility for them to do a true pivot when inflation is running this hot.
Right. This is a great chart we've just added here, and it really illustrates the correlation between liquidity and the stock market performance. So, Mike, just talk about this chart and why it's useful to us.
Yeah, so we talked about liquidity previously, and normally when we talk about liquidity, we just talk about the money supply, M2, and the year-over-year change. And we understand that this is an element of our framework that can be difficult to see how it directly impacts financial markets. We get that. And so this is sort of a subset of liquidity, this net liquidity measure, that we think clearly shows how this drives equity markets and relates directly to equity market performance. So what the net liquidity measure is, you take Fed assets, you subtract the Treasury general account, and you subtract the amount of assets in the reverse repo program, reverse repurchases. And what you get is that that green line. And what we've overlaid there is the S&P 500, and this is since COVID. So you see this massive increase in net liquidity. This is the true liquidity, the true money that can be leveraged to make money in the economy. If you take the Fed assets, you subtract out the Treasury general account. Treasury general account is just the money that the Treasury has from collecting tax receipts or for a rainy day that is sitting on the Fed's balance sheet. That money cannot be then used to make real money in the economy. So it's not true liquidity. It is money, but it's not true liquidity. And the same thing with reverse repos. So a reverse repo means I have cash and I want securities. So I give the Fed my cash and I take securities. Literally, it is useless liquidity. It is not liquidity that is being made to create more liquidity. So same thing. So if you take Fed assets minus those two things, you get the true amount of liquidity that is out in the economy that can create money that is on bank balance sheets. And that definitely drives asset prices.
So just take this forward. So as net liquidity continues to decline, we should see the stock market follow.
That's exactly right. This is what has driven the equity markets since COVID.
Right.
And you see how much net liquidity has already fallen year to date. And the Fed is just now starting to reduce the size of their balance sheet. And they're going to start reducing it at an increasing rate once we get to September. In September, they'll be reducing the size of their balance sheet by twice the pace of the prior quantitative tightening. So there's no doubt that this green line is going to be heading down. There will be fits and starts, but this green line is going to be heading down into the right.
Right. And with a slowing growth, with corporate earnings under pressure, with a lot of comparisons year over year coming down, this is going to just add fuel to the fire, right? It's It's not
Correct.
going to provide a good backstop here for growth.
It is definitely a headwind.
So let's turn to growth, because the next question we got just almost as much as the bottom in is, are we in recession? Talk about it. So Mike, are we in recession?
And what everybody's realizing is we all wish we could give a simple answer to this, but it's not. It's an extremely nuanced discussion. So what we had was 2 consecutive quarters of negative real GDP growth. In many countries around the world, that meets the technical recession definition, 2 quarters of negative GDP growth. In the US, we do not define recessions that way. We have a National Bureau of Economic Research who has a business cycle dating committee that on a discretionary basis will assign those red bars on this chart, the actual recessions. So we are in a technical recession. Yes. Are we in an actual recession? Debatable. We have to wait for the National Bureau of Economic Research to say that. But it is quite interesting. There's only been one other time since the BEA has been publishing real quarterly GDP data that we've had 2 consecutive quarters of negative growth, but NBER has not declared it a recession. The only other time was 1947, basically the very beginning of this data. And what's similar of these 2 time periods is inflation was running very hot. And so real growth was negative. But these 2 quarters of contraction, these are in real terms only. On a nominal basis, after you add back inflation, the US economy is posting very strong growth. I mean, above 6% growth in each of the first 2 quarters on a nominal basis. Then you strip out inflation and the growth is negative.
Yeah, I think that's an important point. A lot of people don't sort of understand the nuance there. That's why it feels better than it looks, right?
Yes,
perhaps.
Exactly.
Yeah.
Exactly.
So where does this number, where does this GDP growth number trend towards, given what we're seeing in the economy?
We've still seen pretty consistently throughout the year, and especially since May, that the economic data that's coming in is coming in worse than expected, and expectations for the full year are coming down. So still the consensus estimate for real GDP growth for this calendar year is 2%. Now that's about half of what it was to start the year. But you already had a negative 1.5 and a negative 0.9. So to get 2, given this liquidity slowdown that we're coming into, given that month over month inflation right now is still running at an annualized 5 to 6% rate, it's tough to see how we could just have a rebound in growth here.
Mm-hmm.
Aside from anything beyond, a slight inventory rebuild. So those estimates in our view are still too high. They should still be coming down until those things are resolved.
And what's sort of as we look forward, what is the time frame we could see here before growth does start to rebound?
Yeah. Potentially, inflation, if you look at the month over month inflation data, because that's really going to drive most of this, our models suggest by the time we get to Q4, we might actually see some negative month over month inflation data. Once that starts to happen, then the liquidity picture maybe bottoms. And so you're basically setting up for something like mid 2023 before you might start to see a rebound in economic growth. Mm-hmm. Until then, putting this in the terms of our framework, we are going to be in a slow and falling growth environment, most likely.
So we could enter a full recession as defined by the NBER, right?
Definitely.
And maybe we throw up that last chart and talk through the indicators.
Yeah. So NBER, their business cycle dating committee, the data points that they look at to determine if the economic contraction meets their broad definition of recession, they're listed here at the bottom of the page. But so it's real personal income minus transfer payments, non-farm payrolls, personal consumption expenditures in real terms, real manufacturing and trade sales, household employment, and industrial production. And they look at all these data points on a discretionary basis. It's not made by formula. And they determine if the economic contraction met the definition of recession. So what we've done in this chart is just took each of those indicators they look at and averaged the 6-month change since 1959. And what you see is right now they've grown over the past 6 months at 1%. So what we're basically saying is there is almost no chance that Enver would look at the first 6 months of this year and claim the first 6 months was a recession. So that would only be the second time in history that we've had 2 quarters of negative GDP growth without Enver claiming a recession. However, once again, way too much nuance, right? If you look at the month-over-month change of these data points, they went negative in May, and we're also negative in June. So if the economic data continues to slow, it's quite possible that sort of retroactively, Enver could come and say this economic contraction started in May 2022.
Right.
That is a relatively high probability event if the data keeps slowing as it has been slowing.
Yeah. So more to come there. We'll keep you posted on that as it evolves. Any final thoughts as we head into the month of August?
No.
All right.
Oh, sorry. Go ahead. You can do the close.
No, that's fine. That's all right.
I was going to say something like, if you look at all bear markets since 1929,
yeah,
pretty much every single one has a retracement of 40 to 50% of the initial drawdown.
Yeah.
And 40 to 50% of the initial drawdown is 4150 on the S&P, and we closed July at 4130.
Yeah. Yeah, we are.
It's almost spot on.
Yeah.
With the historical experience. There's only one bear market that didn't have a bear market rally, and that was COVID. And why? Because we had the greatest liquidity response we've ever seen in history. Right?
Yeah. Yeah. I mean, I think we're seeing exactly this play out like it does textbook from all the prior bear markets, and it looks just like we've peaked out here in July, and August and September should be very interesting. If we can move meaningfully above that 4150 mark, maybe there will be a bottom. The data doesn't support it, but we'll keep an eye on it. Mm-hmm. So thanks for joining for the July update. If you have any questions, as always, let us know. We're happy to discuss any of this and our outlook with you. And have a great last month of summer.